guys. Okay, so today we're going to talk about how does the future of asset management looks on chain. Interesting topic, several elements. We're going to discuss several elements here. And I'm going to start with a controversial question, first of all. So I was traveling last week on the highway here, and I saw a billboard on the highway where a TradFi pension fund was kind of like advertising a double-digit ROI. So my question here is playing the devil's advocate. If it's not broken, why fix it? We have double-digit ROIs.
But it kind of is broken though, because it's like that double-digit ROI is based on trust me, bro technology, right? Like when you're doing asset management on chain, whoever is like entrusting capital to you can see exactly where and how you're deploying that capital and can block by block basically validate that they are getting the return that you're reporting to them, right? Whereas, you know, conventional financial system, you have 15 intermediaries between the person that takes your money and the person that actually makes the investment decisions. And you have absolutely no idea like if what you see as a report is actually what happened and where that yield came from. So I think it's pretty broken.
When I started building, because I actually come from traditional asset management, I was working in an investment bank, and so I would say that yeah, it is not broken. I think that, for example, pension funds in United States have been having like a very good performance for the past like 10, 20 years. For me, it's more about like accessibility, like who can actually access such investment schemes. The second one is the fees. Majority of the time, those private investment vehicles, those private pension funds actually charge a lot of fees. So you as an end receiver, you know, you are really getting much smaller return than you would actually do if you are investing by yourself in the same markets. And what Ivan said, what he started with, it's a lot of it is like trust me, bro. Yes, it's like if something is going there which makes the fund like underperform, you don't really have clear visibility of how and when that is happening. Yes, you have one report at the end of the year that you're going to read, but in crypto, in asset management, in DeFi, you know, as soon as something happens, everybody are already talking about it. You have that transparency that is really missing from TradFi. And yeah, I would say another thing is that we really don't see a lot of the shit that is happening on traditional finance. We see everything that is happening in crypto simply because people see it on chain, it's transparent, and everybody start talking about it right away. But I got my debit card stolen literally like 2 months ago. My bank did not even want to tell me that my debit card is stolen. They just blocked it and said, oh, you need to fly to Bulgaria in order to get yourself another debit card. Yes, obviously not going to mention the bank name, but you can imagine the amount of stuff that is happening in TradFi.
Yeah, transparency, it's important. You were mentioning 10%, but from where it comes, you can't know. You have to trust the people who advertise those 10%. And I wanted to add more about accessibility. It's true that in Europe, in America, we may feel that, okay, I have access to investment vehicle. Why do I need DeFi? But we have to think about other people. You know, DeFi doesn't have the same value for everyone. Me as a European, maybe I like DeFi to generate yield, but if I was living in Africa or in some countries where you have not access to all those vehicles, actually I will value DeFi way, way more.
Okay, awesome. So I'm hearing trust, I'm hearing transparency, I'm hearing access. Some of you said fees, which is something that we might get into a little bit later. And I think you need a new bank, first of all. So yeah, just I guess. But yeah, okay, cool. So I want to touch on one of those things, which I think it's very interesting, at least for me, the access point of view. So, you know, Pascal, you're saying about how DeFi means different things for different people, right? And there is this promise in DeFi that it will make financial tools generally more accessible, right? Have we already seen this happening? Are we yet to see the accessibility factor starting to play in, or we see this massive wave of people come in? And when are we going to see it if it hasn't happened already? Like this cycle in 5 years, or how do you foresee the accessibility element playing in?
So for sure, not this cycle. Maybe in 3 years, 5 years, but then when we speak about the adoption, we have to know which adoption we speak about. Do we speak about adoption of institutional companies or individuals? So I think the adoption of individuals will come super mega late because as you all know, DeFi, it's all about self-custody, protocols. I mean, it's very complicated. There is a lot of, it's very complicated to navigate within the DeFi. So we will need a lot of work within the UX, also the security and the education. So I think the first real adoption that we're gonna see, not in this cycle, but I guess maybe in the next 3 to 5 years, will be from institutional, mainly thanks to real world assets. And mainly from tokenized bonds. I think this is where you have the biggest upside for companies. And one other thing is, you know, most of the yield now that you can get in DeFi, it's based on dollar. Here we live in Europe, so we always have to think about the Forex risk. And right now there is not a lot of solution for on-chain euro yield. And the cool thing with real-world asset is that you could tokenize euro debt either from countries or from companies. And then you can work with Aave or Morpho, and you can put as collateral this tokenized debt. So you keep your exposure to euro, but then you borrow USDC or whatever, and then you go to generate your yield. And because it's way more scalable to generate wealth with dollar, rather than with euro, and let alone Swiss franc and all the other currency, this kind of system where you can borrow against national debt or corporate debts could unlock a new wave of adoption, at least in Europe, because European company will be able not to find a way to hedge their Forex risk, which is quite expensive, and they could have the tools to generate yield on-chain by keeping an exposure to their local currency.
Yeah, DeFi adoption, like from retail, is definitely not very close. There is still a lot of things that needs to be done, mainly with like how we are going to onboard those people in the first place. But I would say like stablecoins, for example, already have shown a massive product market fit. Yes, and maybe in Europe and in United States, not that important, but in Africa, in Southeast Asia, you know, there are people that receive their salaries in stablecoins, they transact, they pay services in USDT. So this is already there. Also, like the onboarding has kind of been solved in a very decentralized, you know, P2P manner, which, you know, it's not as scalable as being able to onboard people via banks, yes, like going to the bank and give your cash and they give you like USDC. It's not that scalable, but it's, I think that for the current state of the industry, it's sufficient enough to be able to allow us to continue onboarding millions of people into crypto. And for DeFi to get there, yes, for that money to actually be plugged into the ecosystem, we really need the service providers. I don't expect that people are going to be DeFi users by going there and doing it manually themselves. They're always going to go through some, you know, asset manager, curator. They are going to get like a curated experience for earning money from, like earning passive income from the assets that they hold on chain.
Yeah, I was gonna disagree on the adoption, but then you mentioned the stables, and it's like, God damn it, you rigged my point. But speaking of rigging, I think retail is probably not gonna come soon because of CFI, right? I have a good friend in the US. He took out a mortgage, chucked the money into BlockFi because the yield was insane compared to the mortgage, and now he doesn't have the money, right? And that experience sticks with you for years, right? Like, it's not gonna be like, oh, it's 3 years later, I'm gonna like try it again, right? You've lost like 6 figures to a company that was LARPing as part of this ecosystem, and you know that stings. You tell your friends, you tell your family, like there's gonna be a lot of stigma because of past mistakes. And on the flip side, when it comes to stablecoins, right? Like last year we were at DevConnect in Istanbul, and there was this like, oh, like be careful, payments in crypto in Turkey are illegal, blah blah blah. And then you go to the I don't know the name, like the massive market, like the bazaar in Istanbul, and like you can pay in Tether for everything to everyone, right? Like, so it's not only that like adoption is not promoted, it's actually actively hindered by a government, and like still people use it because it solves a problem. So I think we've proven that there is product market fit for certain products. Ideally, that universe would be expanding as we add more abstracted or as you said, curated experiences that are easier to click for the everyday person. And I also agree, like organizations coming on chain makes a ton of sense. Again, across like no-brain use cases like remittance, FX, yield.
Yeah. No, I really want to talk a little bit more about the, as you said, the product market fit of the stable coins. And yes, about DevConnect, yeah, I think I had the same experience there as well. But about the stable coins, and I'll get back to what you're saying about this being hindered by the government, but stable coins, 100% agree. I'm on the same page. There is a product market fit there, right? But there is this bitter taste sometimes from situations like your friend. And then the conversation about regulation starts coming up, right? And how are we thinking about the regulation environment at this point? Because we can all agree that, the uncertainty that we have in our space is there, and we need to maintain a level of trust and liquidity while navigating that. So generally, my question, probably I'll start with you. How are you thinking about the general regulatory uncertainty that we have today?
I prefer not to think about it, if possible. It's just been enforced on us. So I think generally there are clear bad actors in the space, and the fact that they get away with just slap on the wrist, right? There is a famous project, they raised like 4 billion a few years ago to build an Ethereum killer, and then they got a 25 million fine, which is a joke, right? And then on one hand, projects and teams that are trying to stay compliant struggle, and at the same time, if you're just like gunslinging, do whatever you want, even if you get caught, nothing happens. So I think the regulation in its current state actually punishes good actors and like creates moats for those willing to step over the line, which is quite problematic. So hopefully we'll there's Coin Center, there's UC, there are like a few initiatives trying to educate regulators on how to deal with this. But I don't think they're going to come and save or help meaningfully, because we've seen this with like digital media, right? Like adequate regulation came 10 years after everybody was on Facebook. So I think unfortunately regulation is not going to meaningfully protect individuals in the near future. It might help onboard organizations because they would be feeling more comfortable touching and interacting with our ecosystem. But you as a person, self-sovereignty comes at a with great power comes great responsibility, and people should be looking out for themselves to a large extent, unfortunately.
Yeah, so I'm very anti-regulation. Like I said, I come from traditional finance. I was working in an investment bank. Why I left the industry was because of compliance and regulation. Was because I saw how people that work and live in different parts of the world basically do not have basic access to financial services. They come to you, they ask for services, and you cannot provide to them simply because they are from a country, like let's say they're from Peru, And whatever you do, no matter how much documents they fill up, your compliance department is never going to approve them to become a client of the bank. Yeah, so this is the reason why I was like, okay, I don't want to do crypto banking, I want to do crypto. And one of the first things that I wanted to build actually was a derivatives exchange that allows you to trade, commodities, gold, stocks using crypto. And the slogan was democratize access to speculation. Because really, the accessibility that crypto provides to financial services is, for me, what makes it so special. Of course, didn't operate that exchange for obvious reasons. I also don't want to go to jail. Yeah, but yeah. Regulation should not be like a minority report type of enforcement, like where it's, oh, I think that in the future we might do something bad, so I'm going to kneecap you from now, If something bad happens, if the protocol does something bad, or if it works with terrorists, okay, welcome, go, chase them, after them, punish the bad actors, but you cannot start hindering everybody from the start before they have even had the time to build something meaningful.
So for regulation, first we have to remember why we have regulation. We have regulation to protect people who don't know. Like if you don't have regulation, everybody can do whatever they want and you can scam literally easily everyone. But doesn't mean that you need a regulatory body. In Switzerland, you have self-regulatory. We can have self-regulation. I think in DeFi, we are many mature people. We know what we should do, what we shouldn't do, and we can all create a self-regulation system where we have guidelines, not something, as you say, ultra strict, because strict regulation kills everything. But regulation should be guidelines like how to do good, how to don't scam people, how to make sure that the people who use your protocol know all the risks, but literally all the risks. It's what, for example, Ethna has done. They have done a very good job as at displaying all the risks that you can occur. And regulation should be this, just to teach a user, hey, if you do this, this could happen, and not too strict like we have in TradFi, and basically that's all. And something else about the uncertainty, I don't think it's bad to have regulatory uncertainty. Like you say, we first innovate and then we regulate. But the cool thing with DeFi is that unlike TradFi, if tomorrow you create a Web2 startup and you do something and then regulation comes, you're dead. Like you're just bankrupt and you have to do something else. In DeFi, it's actually super flexible. Okay, regulation comes, let's do something else, we change some stuff and we can easily adapt. And I think this is why I'm not really afraid about the regulation uncertainty.
Yeah, there was this interesting talk a couple of months, or maybe last year, the regulation benefits the incumbent. I don't remember where the talk was from. It made some waves there, but that's an interesting take. And I like what you're saying, Pascal. That it's about self-regulation. It's about the level of maturity that we have within the space. And I want to switch a little bit because I think we are talking about as Dimitar said, people from Peru, accessibility. And I think, Ivan, you mentioned about, or I'm not sure, about people coming in through service providers, right? So I want to link kind of those topics. And I want to ask an interesting question, which I'm interested in more. What about asset managers? How should asset managers think about the on-chain world? Or should they even think about this as people who are guiding us into the world of asset management in general?
You said the OG or the legacy world? Like as in crypto OGs or like normies? Who should, just to make sure I can answer the question correctly.
So my question was more about normies, I would say.
Okay.
Let's start there.
Yeah, it's welcome on chain. Let me be your guide kind of situation. I think a lot of it is because one of the things we love in this space is creating new terminology. So I think people with like you with experience across both traditional financial systems and DeFi would serve as a bridge to translate concepts that we have in a language that is comprehensible for someone that has to fit within a certain context and whatever mandate they have. ultimately, bringing traditional asset managers on-chain is beneficial for both ecosystems. It provides the traditional world with an opportunity to get exposure to the best performing asset class in the past 20 years or so. 15, whatever. At the same time, one of the challenges that a lot of protocols have experienced is like, there's a lot of venture capital coming in the space, and there's a lot of people that are willing to invest in a project at its earliest stages, and then later on there is no support, no activist investors, no liquid token investors. So a team that is in the early innings gets a lot of support, and then support, I mean by like actual professionals that make investment decisions for a living and know how to direct the team towards returning value to people that have supported it financially. So I think the inflow of not only capital but also expertise that can help projects evolve and move further into their development is a big net benefit for us as an ecosystem.
I think that for asset managers, the first thing is like DeFi in general is really a land of opportunity for them. In traditional finance, everything is already so efficient. So, for example, if you're investing in a money market fund, and I give you a list of 100 money market funds, and you see their performance, it's going to be maximum 10 bips difference per year of the same class, the same type of money market funds. If we're talking about like a DeFi asset manager, which is optimizing for yield, utilizing a spectrum of, let's say, credit markets on Ethereum, the difference between somebody that is just like, I'm going to deposit all of my money in Aave, and somebody that actually understands, has the data and intelligence of like, okay, which strategies are right now very popular? Where are borrowers willing to pay much higher borrowing rate, which means that for me as a lender also means a lot higher yield. Yes, the difference between those two parties is not going to be 10 basis points. It's going to be like 1,000 basis points. That's massive. So first, it's a land of opportunity. Second is for them to also get a little bit more, supported by builders like us with building more familiar tooling. So right now, asset managers come into DeFi, and you cannot expect that those people are just going to go there and go to the front end and click buttons with MetaMask and deposit and withdraw and leverage loop. Yes, you need to build the infrastructure that they are already familiar with. You need to build aggregators. You need to build data flows. You need to build the compute, so they can just come in. They are already very smart people. They can read the data. They have the data analysts. They can create complex strategies. So it's now like, how can we help them to actually be able to execute successfully those complex strategies, and of course with that be able to onboard a lot of users and new money flow into the DeFi space.
We can also automate everything from the risk management point of view. Like if I want to give my money to an asset manager or someone who is dealing with crypto, I have to trust him that he doesn't run with the money. But now we have on-chain tools like smart contracts. So of course we have the multi-sig wallet, but now there are better things. You can put your money into a smart contract, and you have to whitelist some strategies. So for example, you give your money to an asset manager and you say, I just want you to do arbitrage between two money markets. So when Aave pays more, I want you to put my money into Aave. When it's Morpho, I simplify a lot. But you can say, I want this smart contract to can only send money to Aave or to Morpho. So for the risk management perspective, it's way easier. It's streamlined. It's way more streamlined. And so this can help a lot asset manager to actually do their strategy. They can present the strategy to their clients, and if the client agrees, it is whitelisted, and the asset manager can take the money and run and do whatever he wants with it. So on-chain asset manager, they start having and they will have more and more tools. There is a problem of the accounting. This, it depends on the country where you are. Like I was speaking with someone just a few minutes ago. He's in Bulgaria. He would like, we were speaking about DeFi strategy and said, oof, I don't touch this. Not because it's not good, but because from an accounting point of view, it's a hell. So it's not just DeFi, what's happening on-chain, but we also need accounting solution and the country also to recognize what to do as transactions. But yeah, for on-chain tools, it's a dream for asset managers.
All right.
Absolutely. NAV calculation on the smart contract level is just a game changer.
Yeah, but sometimes you can't calculate the NAV. So now there are some projects that use either Kleros or UMA, and they calculate the NAV themselves, and then they ask UMA or Kleros to challenge, like, okay, do you think the NAV is to calculate the value that your funds has at certain points? Like if someone gave you 10K and you made money, then the NAV is higher. And it's important to know what's the NAV.
Yeah, true. If you want the money to go cross-chain, you would need some type of Oracle solution, but really just having like an earn product where everybody can deposit their money, and then all of that logic of like, okay, what is the performance? How does the share price of that fund increase is happening in real time, like block per block. That vault knows exactly how much money it has, and if a user goes and they want to redeem their money, it's not going to be like, oh, it's T plus 1. Yes, let me calculate it first, and tomorrow I will send the money to your bank. Yes, it happens instantly. So also from composability point of view, for money to be able to flow with that speed, at the cost of Ethereum transaction, and that's on mainnet, it can be a little bit prohibitive, yes, but you also have like layer 2s where, for example, we run a money market fund on Arbitrum, which for one or 2 weeks, it have already rebalanced itself 400 times, because the cost of transaction there to move asset between the different credit markets is very, very cheap. Yes, this is nowhere you're going to see something like that in traditional. So it's much more advanced. So it comes with speed, it comes with efficiency, it comes with transparency, and I would say security, because the security is programmatic. It's not based on, trust me, bro, I'm not going to run with your money. Yes.
Yeah,
Also, no, go ahead.
So something that Pascal mentioned around like specifically on the topic of security, right? Like we had this case where regulatory pressure, not regulation per se, created problems for Silicon Valley Bank, right? But it was Friday, so everybody was like freaking out for an entire weekend, because it's like, oh, like if I go there on Monday to withdraw my money, will they be there, right? And on chain, so for example, we use the setup that you're describing where, like the client whitelist strategies, and then we can only move assets between those strategies. And then on top of that, you have like a service provider that detects exploits, and we can literally automate like above a certain probability of an exploit, just withdraw the capital, and then make sure you're safe. Later on, we can investigate and figure out. And yeah, sure, you have the cost of like foregoing return for 20 minutes, 2 hours, 2 days, or whatever. But you have this automated security, which in the traditional markets is just not possible, because the traditional markets get closed on weekends and public holidays.
True. Very
I just wanted to also, from a UX point of view, from all the things you said, we could also tokenize the investment of people. So if you want to exit the funds, instead of exiting, you can also sell your token to someone else, and this is very useful.
Awesome. Okay. Let's have some questions. How about some questions? Any questions in the audience? If you have questions, there are 2 microphones, so feel free to ask our lovely panel. Seems like it was very clear. Okay, let me ask a final question then. If there are no questions from... Oh, there's a question. Please, go ahead.
I'll ask one. I'm obviously biased, so I'll ask something not related. What do you guys think about AI automation for asset management strategies?
You need to teach the AI So you have to give the AI, how to think and how to react. But as an automation tool, I think it's very useful. I mean, I'm using AI not for investment, but for automating many things in my life. I can't imagine a world where you can't do the same thing for risk or strategy automation.
Yeah, I don't think that it's there yet. I mean, AI is quite stupid. It's like it will give you good results if you give good inputs. Yeah, so it really depends on like the input that you're giving it. I don't think that AI can do automation. You can write a very simple script. Yes, if you have the data available already, you can write a very simple script to do the automation, and it does not really require the use of AI agents. But I think it will get there. Yes, we just started with this. Probably in like 2-3 years, there are already going to be, there is going to be enough data. There are going to be enough reference points for AI to actually observe behavior of different markets, different currencies, to then be able to suggest what strategies should be used to maximize the profit and minimize the volatility of returns.
We have the same friend who runs quite sophisticated strategies on option markets in Shanghai. And I've spoken with him about this topic at length. Same feedback. Like AI is not at a place where you can let it manage money autonomously. Like we've all seen this. Oh, I gave ChatGPT or whatever abstraction of it $100 and it made me 3,000, and that's extremely heavy survivorship bias, right? Because we hear only about the good cases, and especially from like the perspective of someone who has to manage capital for other organizations, like the AI fucked up is not what I want to tell people that have given me capital to manage. So it's like we're quite far from allowing it to make decisions. 100% it helps with automation and like report generation, etc. But like it's not there yet.
It could be useful for risk. Like you can give the AI 2 smart contracts and you can ask them, okay, this protocol claims it's a pure fork. Can you see if the code has been changed? Or yesterday there was an issue with Radiant, and the computers of multi-signature signers have been compromised. If we have AI, and so whatever they were displaying on their web browser, they were seeing something fake. And even the simulation given by the Safe app was fake. If you have a separate AI instance and you say, hey, I'm about to sign this transaction, can you give me the outcome? The AI could be able to say it. Yeah, I'm using it sometimes for smart contract. Like, can you read this smart contract, tell me which features I should use? Or you can ask them, okay, what are the risks involved with this smart contract? What are the admin rights and so on? So in that sense, AI could be useful, not to take decision on investment, but to help measuring the risk of this or that protocol.
Okay, seems like it's not there yet, but it might be there in a few years. Cool. Okay. Any other questions we have from the audience? Yes, please.
Hello, Valentina from Hacking. My question is about security. They were mentioned that there are some automated tools which do on-chain monitoring of transactions, unusual patterns on-chain. And my question is, others, I think maybe to Karpatkey, are these tools developed inside the enterprise, or it's somewhere outsourced from security companies? And when something bad happens, who has control over these transactions, like the fund manager or the asset manager or that company and people from security side?
So the service we are using is called Hibernative. I think it's probably one of the most adopted ones in the space. And ultimately, the action taken is just risk off mode. So basically, capital gets withdrawn to the safe, the multisig where the assets are held. So it's not like proactively moving to a different place, right? So it's sort of, the action reduces risk. It doesn't create new types of risk. The only risk with that automation is I'm going to lose on the yield, right? Like it's not gonna cause a transfer to a new address or a transfer to a different protocol where, actually things can go wrong. It just withdraws capital back to a place that has been verifiably safe.
All right, and with that, I think we can end the panel. Thank you very much for the insightful conversation. And if you have any questions afterwards, feel free to find the gentleman. Thank you.
Thank you.